Hey guys, welcome back to Cooker Concepts. Today we're going to be covering some of the dynamics that contracts hold, explicitly risk profile. Um, the wheel strategy in particular is not my favorite with the risk profile it carries, so I modified it a wee bit to make it suit more towards my style. I'm going to share that with y'all today, and I hope y'all enjoy. So first, let's go over some basics. There are only two types of options in the stock market. There's calls and there are puts. We can buy or sell them. You can sell a call, you can buy a call. You can sell a put, you can buy a put. Okay? Not very hard. Now, again, when we sell a put, we're collecting a small premium and we're insuring somebody else. We're saying that if the stock goes, down a bunch, we're going to buy that stock from you. And you're just going to give us a little bit of money. So the upside is capped by that little bit of money that we get, and the downside is potentially, unlimited. It could go all the way to zero. Okay, so limited upside, unlimited downside. When you sell a call, the same thing happens. You collect a premium, but you're agreeing to sell a share at a strike price at expiration. In other words, collect a small amount of money, unlimited downside again. This is not ideal. I do not like this. And that's how the wheel strategy works. Sell the put until assignment, you get assigned, sell a call, get assigned, and you keep on cycling over. And the whole idea is you should be able to collect more premium and space out your strike prices enough in order to actually be profitable. But there's a theory. We call it the perfect market theory. And that's the idea that the market is perfectly priced in for risk. In other words, everything that we do here is summed to zero if we do it long enough, statistically. A good example of this is like, let's take a six-sided die, and I'm going to give y'all $100 if you roll a 1 through a 5. But you're going to give me $500 if you roll a 6. You might think that sounds like an excellent deal. Statistically, it's not. The game is worth zero. So, how do we fix this in options? How do we make it to where the game isn't going to be zero? Simple. First off, we target. Let's go make another slide actually. Okay, so I just made these rules up. Follow them if you want, break them if you want, bend them, doesn't matter. It's a blueprint. But rule number one should be we should target companies that we want to own for the long term. This is a long term strategy that benefits from time and upwards movement. Um, and the real reason I say rule number one should be this is because when the stock plummets to the floor, I don't like people who cry and are upset that the stock is plummeting. It should feel like a fire sale, like you're happy to buy it for cheaper. Rule number two is no margin. Warren Buffett said this best. If you're really good as an investor, you don't need margin. And if you're a fool, you have no business being anywhere near margin. Margin is a lending business that is kind of there to fuck you, especially because you are giving up control of your portfolio unless you have insane capital requirements and aren't using full amounts of margin. Rule number three is one underlying at a time. This particular strategy is incredibly capital demanding, but also incredibly capital efficient at the same time. So personally, I do one underlying at a time. Maybe y'all have big enough accounts to where you can juggle multiple underlyings. I just don't like doing three leg strategies on a bunch of different underlyings because it's just too much to keep up with. Rule number four is assignment is going to happen. It's not a bad thing. It's inventory, and it's how we kick off the rest of the strategy. Number five is premiums are first. I sell at the money options. And the reason being is that the premium is the highest and theta is usually peaked at around 45 days out. So selling the put and selling the call work towards my leap or my long leg. And what we're really doing is a strangle with a leap leg, a 2-year leap call. Um, and the reason we're doing this is because usually during the wheel strategy, when we sell a call and sell a put, we're limiting upside and downside potential both ways. And that's less than ideal. We should have unlimited potential to the upside and be paid for Mr. Market smoking crack and thinking that the company should be worth 500 times price to earnings. That's a great thing. Rule 7 that I like to do is I stop selling or I stop strangling the stock once my leap becomes house money. And the reason being is the leap is free and leveraged to the tits, but also the stocks are always skewed in an upward direction over time. So the leap should pay off, especially if you're buying long 2 year, 3 year out leaps. And rule number 8 is volatility is what we want. And earlier I was saying selling options at the money. That does not mean that they have to be sold at the same strike price. They just have to be sold at the money. What I personally do is I sell my put until assignment, sell another put, and then afterwards start waiting for upwards moves and start selling that call. And as soon as I sell a call, I advise on buying a leap immediately. And the reason being is it protects you from upside exposure. Those are all my rules. Now I'm going to get into a little diagram and show you how this should actually work and what would happen if the stock goes up, down, or sideways. All right, here's a little infographic I made. Hope everyone likes it. And the reason I titled this is because I want to really drill this in, and that's that the 111 strategy is not a part of Theta Gang. Theta Gang rents stocks using those option derivatives. We are not renting stocks. We are owners of stocks. We are long stocks. We are investors, and we should be paid to wait around. And that's why I don't like dividends, is because something like this is better than a dividend, in my opinion. So here's a tiny infographic that should help you understand the strategy flow. So we're going to buy a leap. This is our core position. It allows us bullish exposure and leverages us to the tits. Not only that, it gives us 2 years of being right, or the chances of being right. We don't have to be right today or tomorrow, but 2 years, I'm wrong entirely for 2 years, unacceptable. So when you buy the leap, you get IV expansion, and it gives you that convex upside, which is a fancy way of saying uncapped upside. We sell our cash secured put, gives us IV harvest, and reduces cost basis. We sell our call, extra IV harvest, caps upside slightly, but is covered by the leap. And we keep doing it over and over again. We manage our outcomes, we get our directions, and we keep on going. But let's walk through one more time on what each one of these legs is actually doing. When we're buying a long dated leap, we are establishing a long-term bullish stance. We're creating a convex upside, which is just uncapped gains. So what can happen? The stock rips upwards, the leap dominates in returns, IV spikes, leap gets even more expensive. We're protecting our downside, time passes, a little bit of decay. Eventually on expiration day, which is usually when I let my leaps, expire or whatever, your broker will come in, sell your leap for you. You get to collect the money. That was practically free, and by then you should probably be already onto another underlying and strangling the hell out of it. So the role in the system is positive vega, positive delta. We make money on volatility, and we make money on upwards moves, which, if you don't know, vega is volatility. Delta just means the amount the option changes for every 1% that the stock moves or the underlying moves. So 2, what happens when we sell a cash secured put? This is our volatility harvester. We need this. I would say this is probably slightly more important than the call. What does this do? It generates income immediately. As soon as we push the sell button, bam, the money hits our account and we put down the amount needed to enter this contract. This lowers our effective cost basis, gives us the chance to buy the stock for cheaper, and monetizes volatility instead of predicting it. So let's say the stock becomes choppy, the premium offsets the leap decays, or let's say the stock dips. You get assigned at a discount. Lastly, the IV could collapse, the put decays faster, and you still win. It's amazing. And you might be like, well, then my leap might start getting eaten away. That is true, but think about it like this. You just were able to sell a free call and probably a free put at the same time while lowering cost basis. It is amazing. So negative vega, but you have controlled downside and it is limited. Lastly, we sell our calls only when the market offers them, because let's say you want to buy this stock and you want to go long on it. Well, if you start selling calls, you're limiting your potential upside. So what I do is I like to sell calls when I think the stock has overextended for a short period of time. So I'll swap from selling a ton of puts to selling a ton of calls and being like, I'm a little too overexposed in this. I should probably lower my exposure a little bit so that way my portfolio doesn't get blown up again. So what does this do? We're harvesting additional volatility. So if volatility goes up, we make more money. If volatility goes down, well, we make more money by decaying our contract faster. So after direction or assignment, it further reduces our cost basis and it converts time into cash flow. It doubles the cash flow. It essentially allows us to lower our cost basis at twice the time frame that we would if we were just selling a put. Not only that, it protects us from sideways. So if the stock stalls, the call expires worthless, free premium. If the stock runs, oh no, we get our shares called away, but oh great, the leap, it covers us and we win from our put. So let's just say IV gets elevated, premium is still maximized, we can keep selling it over and over again, whether it goes upwards, downwards, doesn't matter, the premium increases. And that's why I love the strategy. That's why I love the strategy so much. Put very simple, it allows IV to be your friend. And when it comes to selling options or buying options, it makes IV just come out of the equation so much because people do not like to sell options on low IV stocks because it lowers your premium. If something only moves, a butt hair every year, it's very easy to predict it's not going to blow up. So this allows us to target almost any underlying we like and not have to worry so much about IV. So let's get down to this last part and say what is actually happening to our outcomes. If the stock goes up, our leap runs. The put expires worthless. Upside is not capped, unlike the wheel. In other words, the leap just takes over for us. We have a synthetic ownership, and it's leveraged to the tits. So you put down a fraction of what it would actually cost in order to own those 100 shares. If the stock goes sideways, the leap bleeds, but it bleeds incredibly slowly. The put premium offsets the decay, and so do the calls. The net exposure, a discounted synthetic stock. This can be considered a bad scenario. It's not. You got the leap for free, and we're going to be stuck making no money if you had just held the stock anyways. And if the stock goes down, this is the only time that we really lose. And the problem with this strategy, it is incredibly capital demanding. So if the stock goes down, we get our puts assigned at a lower cost basis, sure. But if the company goes bankrupt, we lose 100% across the board, even if everything works out kind of in our favor for a short period of time. The main thing that I also want to hammer away is, again, we're not Theta Gang. Why are we not Theta Gang? Theta Gang shorts volatility only. They don't actually own anything. They're just kind of renting the stock or agreeing to be the insurance company. The one-on-one strategy is long and short volatility at the same time. We don't really care which way it goes in, as long as that we're eventually right, I guess. So Theta Gang also needs IV to stay high. You might be like, why does they need IV to stay high? Well, they can't collect good premiums if IV is low. We talked about that earlier. The one-on-one strategy takes IV out of the equation. It does not matter. IV is our friend, and so is time now. Theta Gang caps their upside. If you're right on a trade, you sell the put, you only get to collect the amount of premium you got. That's it. The one-on-one strategy takes that out of the equation. Our upside is potentially unlimited, and our downside is still pretty limited, as long as you're not naked or something. Theta Gang is going to be about income first, to where the one-on-one strategy should be about ownership. That's why we target companies we like. So the wheel rents the stocks. The one-on-one strategy acquires it at a wholesale price without caring about volatility. It can go in any direction. Doesn't really matter. The whole idea is this system is designed to make time our friend and have stocks appreciate over time. Because if you don't know this, stocks are skewed upwards and to the right forever. There will always be like that. So we should take advantage of that idea and make some money off of it. Guys, that's my strategy. That's how I trade options or invest in options, whatever you want to call it. This is Crooked Concepts. I suppose I'll say a safe harbor. This was not financial advice, blah, 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 blah. And until next time.